Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hey Lauren.
Hey everybody.
Hey, Lauren, I know there's been a lot of discussion about, well right now we're in the heat of finishing up the deadlines for tax return preparation.
Exactly.
We're talking about finishing up 2011 tax returns.
Right.
What we do know is that generally most of the provisions in the tax law for 2011 are going to also be in place for 2012.
Right.
But 2013 is a whole different story.
Right.
The notable information is that if the president at this time, at the end of this year, which will be Obama, cannot come to an agreement with the House and the Senate, the current tax provisions are set to expire, and we're going to go back to like the 2001 tax law.
Right.
So you wrote a great note to some of your clients saying the party is over.
Yeah, right. Well, yeah. When it comes to investment taxes, I may get some of these exact dates a little bit wrong, but first there was a change to the tax laws on dividends.
Right.
And the change at first was, well, mostly it helped people in higher tax brackets, but they changed it so that if you had qualified dividends, and for the purpose of this video, we're not even going to explain the difference between qualified dividends and ordinary dividends, because soon it won't matter.
Yeah. but for now, most dividends that you receive from like American companies that are being invested or mutual funds are qualified dividends.
Yes, exactly. Yeah, most of them.
Yeah.
So what happened was, for qualified dividends, the highest taxes you could possibly pay was 15%. And of course, your ordinary income tax rate might be much higher than that. Well, then again, they changed, in I think 2008, they changed it in a way that really benefited people in a lower tax bracket, because then if you were in either the 10 or the 15% tax bracket, zero, nothing. Your qualified dividends, you didn't pay any taxes on them. And for retirees, this was, especially the 2008 change, was a really big deal, because now, you know, your Social Security, that didn't count for these purposes. If all you had were qualified dividends, or then you didn't pay any taxes.
Right.
So you were pretty happy with this. Well, this is going to end pretty soon, and I think it's going to be a little bit of a shock, especially a little bit of an eye-opener for people who have been used to paying extremely low taxes on their taxable investments, as long as those dividends were qualified dividends. Pretty soon,
1/13.
Yeah, exactly. On January 1st of 2013, you're going to pay your ordinary income rate on all dividends, regardless. And most, well, maybe not most people, but a lot of people's ordinary income rate is going to go up in addition.
Because right now the highest rate is 35%, and it's going to go automatically up to 39.8%.
Right.
And then there's also a surcharge on this healthcare bill that adds another 3.8%. So if you're really in the top tax tier tax bracket, you could be paying 43.6% on your dividend income.
Right, so you went from 15% to 43.6%. And if you're in the 15% tax bracket, you're going to go from 0 to 15.
At least 15, yeah.
Yeah, so this is going to be a pretty big difference. And I think it's going to affect the way people think about investments.
Right. Yeah, I think from a planning point of view, like everybody was celebrating that Apple Computer was, for instance, issuing a big dividend finally. Timing was probably not the best time. It's actually better to have low turnover investments with perhaps even lower dividends and generate more capital gains, because at least right now it looks like we'll talk about this in our next episode. Capital gain taxes are going to change. They're not going to be as high though.
Right, exactly.
On that. So I think to look at this proactively, I think Lauren and I would both agree that it's not a bad idea to look at how your investments are being structured, and not worry so much about trying to generate your growth from dividends, but look at what's the whole tax impact of that would be.
Yeah, exactly. And especially, the one really good thing that will come out of this change is that passive investments, whether index funds or the sort of structured funds that we use for our clients, are going to become more popular, because one of the many things that these funds always do well is minimize your tax burden. If you're going to be paying taxes on your dividends, you really don't want to have to pay a bunch of taxes on short-term capital gains on top of all that, which is what you often get with actively managed mutual funds.
Right. Very good. So we'll see you next time on Erickson TV, and we'll talk about the other provisions in the tax law, including capital gains. Thank you very much. Bye now.
Bye-bye.